excited about today's subject. This is one I feel like is one of the hottest topics everywhere I go. When there's real estate discussions and real estate professionals or wannabe professionals coming out of their other careers and wanting to be more engaged in real estate. Bonus depreciation, cost seg, maybe it's called other things. Jeff, I've got the man, the guy here with me today who's going to talk about exactly what this is, how it works, give some examples as well. And so I'm really excited about today. He and I met just a few months ago. I was introduced to Jeff through the boardroom. A lot of you know that I've met a lot of successful people through Kent Clothier's boardroom. Jeff is one of those guys. He comes highly recommended, and I'm just really excited to have Jeff on here today. So to get started, before I have Jeff do a quick intro, and then we're gonna have a little bit of conversation. As always, this is we want to provide as much content and education and just really information for you. And you can take that, go back to your CPAs, go back to your advisors, make decisions on your own, what might make the most sense for you. These are our opinions, and these are some examples that I've seen and that I've lived in my life. That's part of, I've done some bonus depreciation, cost seg that we're going to talk about today, but it also is a hot subject because it's the end of the year. And even though it's probably too late for most of you to do too much on this subject, it's the perfect time in preparation for next year. A lot of people have asked me, one of the big questions people ask me all the time is, when should I convert my traditional retirement account to a Roth? And one of the first answers I give is, if you know, obviously with your advisor, your CPA, that you are going to have a year where you have some depreciation, some bigger tax write-offs, that is the year to convert a portion of or all of your IRA into a Roth IRA. Now, a Roth, obviously we've talked about, many of you have been on here with me before, and I'd say half of you have not been on here before with us. And so usually about half our audience is brand new and half our clients of ours have been here before. And just so you know how this works, definitely put questions in the chat. We're going to get to a lot of questions at the end. This is very hands-on, and we'll answer as many questions as possible. That being said, also, as we get started here and I introduce Jeff, I want to just say that Alex is on my team. He will put our link on there. So for any of you throughout this presentation, if you want to copy and paste our information to schedule an appointment, to see if this applies or how it applies to your retirement account. Or if you're like, hey, look, you guys totally skipped over the whole self-directed IRA presentation because you had Jeff on today, that's okay too. We've got a ton of videos and information, and we do one-on-one phone calls for anyone that's listening who has a retirement account. Currently, if you have a retirement account, it's not self-directed, we're going to help you at Horizon Trust Company get that set up and start working with us on that. But today we're going to focus a little bit on how these things mesh together. When's the right time to take the write-offs with your retirement account, but also what is this bonus depreciation and or cost seg? And before we jump into that too far, Jeff, welcome. Thanks for being here today. And can you give us a little introduction to yourself here today in our webinar?
Absolutely. So my name's Jeff Hiatt. So I've been in the cost seg space since 1999. Our firm started back in 96, and it was an engineer and a CPA. So our world is of depreciation, and our services are at the intersection of real estate, the tax code, and engineering. And where those three pieces fit together, we do cost segregation studies, we do 179D and 45L, which are energy efficiency upgrade tax credits and tax incentives, tax deductions that are out there. So all of that stuff and R&D tax credits. So we help people that typically own properties or own businesses reduce their income taxes with tools that are within the tax code, just like self-directed IRAs are within the tax code. Cost segregation is in the tax code, and that's what we do. So we've done about 25,000 studies in that time. We started, it was an engineer, a CPA, and I joined in 99. We now have 27 engineers and 10 accountant types out there doing this work all over the country.
Perfect. And again, it's such a timely message because everybody right now is I'm getting so many phone calls like, "Hey, how much can I contribute? What else can I do for taxes?" And I'm not a CPA. All I can do is give my advice and recommendations. But this subject is near and dear to my heart. I've participated in it, and I know many of you want to and just don't know maybe the ins and outs of how it works. So let's I know you've got a few slides prepared, and before we jump to those slides, Jeff, can you just kind of give us, from an elementary perspective, what is this bonus depreciation or the cost seg that you do? What is it? We know it helps saves on taxes, but who qualifies for this, and what is it exactly before we jump into anything else?
Sure. So if you have, I'll start with a basic question that may sound like I'm being a wise guy, but I'm not, because it is relevant. Um, and if I ask you, Greg, or any other listener out there, would you rather have a deduction today, or would you rather wait 27 and a half or 39 years to take the deduction? Now, if you're on this call, you're going to respond with, well, I'd rather take the deduction today. If I can take a write-off now, I'd rather grab it now than wait. And so that's what cost segregation does. In other words, when you buy a building, build a building, or renovate a building. So if you touch a building in some way, shape, or form, even if you don't own it, you just do a renovation within let's say, a floor of a building, imagine that, or a retail space. Bottom line is, the IRS is going to say you have to write that off straight line over 39 years. The only difference in 39 years is if it's, let's say, a residential rental property, and then it's 27 and a half. So I'll use those interchangeably in my conversation here, but understand that if the only thing that's 27 and a half is residential rental, whether it's a single family home or a multifamily, like big, 150 units or 6 units, it's 27 and a half. But what you can do as opposed to that is the IRS has other sections of the tax code that will allow you to take pieces of what you've bought, built, or renovated over 5 years, 7 years, and 15 years. So it goes from, okay, if everything's in 39 or 27 and a half, well, wait a minute, if you did a cost seg, you can pull some of those items into 5, 7, 15. And wait a minute, then there's this thing called bonus depreciation, which started really, let's say, full on, or really got ramped up in 2017, where if you buy an existing building or do construction or renovation, anything that gets moved out of the long life, 39, 27 and a half, into 5, 7, 15, anything that goes into that faster life is bonus eligible. So we move, let's say, 20% of what you spent. So you paid, let's say, 1.2 mil for a property. Let's say we have 20% for land being non-depreciable, and we're going to be able to move 25% of that million into a faster life, 25%. So if you did this project or bought it, built it, renovated it in 2017 through 22, and we can reallocate, let's say, 25%, you get to take 100% of that in the first year. So for that 5-year span, it was 100% bonus depreciation. When
Wow.
they put that in the tax code, they also had to put in an exit provision, or what they call a sunset provision, because when they do a substantial change to the way that taxes are charged and collected, they can't just say, we're going to leave it there forever. They have to build in an exit provision. And so that exit provision began in 23, where 100% bonus on the 5, 7, 15 stepped down to 80% bonus. You didn't lose the 20%. The 20% is just over 5, 7, and 15. In 24, bonus went to 60%, 40%, 5, 7, 15. In 25, it'll go down to 40%, 60%, 5, 7, 15. And then in 26, 20% bonus, 80%, 5, 7, 15. And then in theory, in 27, it goes away. To just go full circle with that, last October, the House passed a bill that would have reinstated 100% bonus retroactively to the end of 22. So had it passed the Senate, which it did not, had it passed the Senate, it would have given everybody 100% bonus through end of 26. That
Wow.
stalled in Congress, shockingly. There's discord there. And when it stalled, the Senate never picked it up, didn't go anywhere for this last year. And now that the election is done, it is likely that the new administration will reinstate 100% bonus because they were the ones who started it in 17.
Mm-hmm.
So it's a
Well,
great scenario for real estate people.
so and I feel like just listening to you, we could probably talk about the subject for hours and hours, but obviously we're not going to. And so, for those you listening here and watching, I actually do think this will be helpful for you to show some of your PowerPoint slides that you've got, and so you can kind of give some examples so people can see what you're talking about. And so, again, uh, this is Jeff and his company. What they do is they help individuals. They create, and correct me if I'm wrong here, Jeff, but you do the reports. People hire you, your firm, to do the cost seg, these reports that you then in turn bring to your CPA, correct? Or no? Bring to your
No, no,
CPA,
that's right.
bring your CPA, and now you've got this report that shows you the bonus depreciation that's taken on this asset. You get to deduct that on your tax return, and it is a huge. I mean, we're talking about on these big buildings could be hundreds of thousands of dollars in tax savings, millions on obviously bigger projects, but even on a small, those that qualify, uh, this works like you said on a residential property, investment property, or in a building, or all the above. And I've got lots of friends who every year just do not, they want to pay the least amount to Uncle Sam. And so, they're very aware of making sure they buy and do this cost seg with a company like yours, on one or two or three projects. So they're paying a net, maybe nothing in taxes this year. And then just carry it over from year to year on new projects. And so that being said, Jeff, for those listening, is this the right time for you to kind of go over some examples in the PowerPoint here?
I will, and I'll just give you a little background. So you were talking about this for hours and hours. My Most of my time is spent teaching CPAs about this. So we'll do seminars for anywhere from an hour on the short end for CPAs to 8 hours. We'll do this stuff. So this conversation is a breeze, because it's not an 8 hour in-depth, extremely painful, detail-oriented seminar. This is just quick. But usually what happens is we get referred in by CPA firms. So we've been doing this so long, since the firm's been around since 96. So we have CPAs call us all the time, and we get inbound traffic from the CPA saying, hey, Greg just bought a property, 123 Main Street in Topeka, Kansas. And, he paid 1.2 million, 5.8 million, whatever the number is. And he's got this many units or this many floors on the building. And we then give him an estimate. And then with that estimate, you can make a decision. Hey, does that make sense to me to do or not to do? And usually people look at it and say, hey, if I spend $1 to get the study done and I save myself $4 or $5 of tax, I'm going to do this. Well, we hit that ratio, that 4 or 5 to 1 ratio, at about 400 grand. So if you've spent more than 400 grand on a property. 350 to 400 is usually the sweet spot that this is going to make sense. It's a little bit lower if we're at 100% bonus, but that's kind of the the starting point. We've done everything from little Airbnbs to skyscraper buildings. One of the skyscrapers we did in the Boston area, 32-story building, most everybody in the country has at least one mutual fund with this company. But we can't say their name, but we did their project for them back in the day. And so we've done little stuff and really big stuff. What I've prepared are some slides that kind of will demonstrate a few things that usually come up as questions, and I won't get too far in depth in it. And I'll go ahead and try my share screen. I'm assuming it's going to work now, so I'll go ahead and give that a go. And
Jeff, one other add real
yeah,
quick.
please go ahead.
You do have to be to get this kind of deduction and depreciation. You do have to be a real estate professional, right? By definition, is that true?
Well, I'll clarify. That's a great question. So I would say no, okay, but let me qualify what I just said as no. If you want to use this deduction, okay, how do I say this? Okay, so the losses we create with a cost seg are called passive losses.
Right.
Okay. So passive losses can go against passive income. In other words, the losses we create with a cost seg would offset income, passive income for you that's coming in from rental properties that you own. Now, we could do your building at 123 Main Street, and we could give you passive losses on that, which theoretically might wipe out all of your passive income from building 123 Main Street. But then you have building number 567 on Washington Street, and the losses created at 123 Main could wipe out your passive income from property 567 Washington Street. So it's not like it's isolated. The losses created at 123 Main are isolated to that property. They can transfer or go against any of your other passive income. Now
If you're not a real estate professional.
if you're not a real estate professional.
But if you are, go ahead. Yeah, sorry.
So if and let me just wrap up on the real estate professional thing versus passive income and all that. So the scenario at passive income is it won't go against your W-2 income. Okay.
Yeah.
So if you had bigger losses at 123 Main Street and you didn't have other passive income, then the excess loss for that year would ride in your back pocket until next year, and it would just kind of automatically get paid in, and you would not have to pay taxes the next year. And if it's still
So
flipped
carry
over to
overs. You don't
carry,
look, it's
it's
great.
called a loss carry forward, okay, by the tax code. So we would create a loss carry forward if you can't use it all in the year. Now, I say that if you're a real estate professional and there are some hurdles you have to get over to be able to claim that, but it's basically you spend 750 hours a year managing, dealing with, interacting with real estate, you can claim that real estate professional designation. Note that you need to sign your tax return as such. You can't just say, oh, hey, I'm a real estate professional.
Yeah.
There's a designation when you sign your tax return on the 1040, typically it's on the second page, it's going to say, what is your occupation? And if you say brain surgeon, if that's your main occupation, you're not going to get real estate professional.
But why is that? Why is that important? If you are a real estate professional, then you can do what? Then you can carry those losses right further.
Well, you're right. So it's um, the way that it works then, if you're a real estate professional and you do those things and you're qualified legitimately, and it's not, I'm not making that decision and designation. You and your accountant are. So we're not, I'm just giving you the numbers, and the numbers are what they are. And then how they get applied in your return is with you and your accountant. But you bring up a great point. So that loss, that if you're not a real estate professional is a passive loss only, Now, all of a sudden, the loss we create if you're a real estate professional is an active business trader business, and you get to use it against your W-2 or your 1099,
which is
which is a
huge, huge,
smoking deal.
huge.
In the tax code, it says smoking deal. So, um, and probably again, you need to hit the thresholds, but some people are have maybe their spouse like maybe somebody is an attorney of some sort and they make good money and they're investing in real estate, and their spouse, let's say, um, is managing all that and coordinating, oh, the roofing contractor and the snowplow guy and the landscaper and the tenant leases and all that stuff. If that spouse is doing all of those things, they could, again, with the accountant's blessing and oversight, they could claim real estate professional. And then bam, that loss created on all their various properties all of a sudden could become an active trader business. They're married filing jointly. They're going to get to take real estate professional status, even though the one person is an attorney, the other is managing the properties. They get to combine that, and that's again a smoking deal.
And I just wanted to make that point. I wanted you to make that point because that's kind of how I led. I've got my kind of more real estate professionals that are doing this, that are doing the conversion of the retirement accounts to Roth, because they're getting those losses and they can use them against the increase they got to pay when they convert that traditional IRA to a Roth. And so I just wanted to connect those dots. That's all. So let's move on, Jeff. I think you got go ahead here.
Okay, let me see here. I'm going to share
And,
screen,
and,
I
and
think.
this guys, this is like not 101 stuff, and I realize that. So hopefully you're bearing with us, Jeff. Thank you. Like this is great. So uh, hopefully you guys are finding a lot of value in this. Jeff is the best at this. So, but we are jumping deeper into to really good content here. So thanks, Jeff. So go ahead.
No problem.
Let
Is
you know
this,
when
can you see the screen right now, my screen?
perfect on my screen. Yep.
You can.
Yep.
Okay, great. So we're going to say, because I'm normally teaching CPAs, they don't refer to people as clients or real estate owner. They call them taxpayers. So a taxpayer has bought a 4-unit single structure property in 2023 for 400 grand. So we've already subbed out a land value, land being non-depreciable. So, and again, you can see this picture, right? Everything is coming through okay?
Perfect. Yep.
Good deal. Okay. So that's theoretically what the building looks like. So they bought it for in 23 for 400 grand. So their first year depreciation, if they don't do anything, is going to be 7,800 bucks. That's what they're going to get under straight line. That's the before cost segregation snapshot.
Mm-hmm.
With the cost seg in hand, we come in, we identify that certain pieces are eligible for that faster write-off. So now they're going to, instead of getting 7,800 of depreciation, they're going to get 75,000 of depreciation.
Do you want to, someone mentioned, is it easier for you to kind of skip along this way? Probably. Everyone can still see his slides though, correct? Just want to make sure you can see his slides. I think he's skipping some slides, and that's why it's easier for him to leave it in this mode.
That's why I'm doing it, because
As long as you can see it.
I'm afraid it's
Yeah, yeah.
gonna take over the whole screen, and then I'm not gonna be able to see where I'm headed. So
Okay, perfect. Go ahead.
hopefully
You're
that's
good.
okay.
Everyone can see it. Perfect. Go ahead.
Um, okay. So what's happening here is, instead of 7,800 of depreciation, they're getting 75,000 of depreciation first year. In other words, they're taking it sooner versus later. They picked up 67 grand of depreciation with the cost seg. That's going to reduce their income taxes 27K. Now, 23 was 80% bonus year. So they're getting to take, um, as you see there, the 21% accelerated
Mm-hmm.
uh, that you see there. They're getting to take 80% of that right away. So now we're going to deal with another taxpayer, another buyer of real estate, and they're paying 1.2 mil, again, net of land, and they did this in 2016. This would have been prior to any bonus being in play for a purchased property. So now, and so what we're showing here is stepping back in time, because that's one other element of cost seg that's in play for people, is people ask, I think I saw one of the first questions pop up in the chat at the beginning was, well, do you have to do this the first year? No, you don't. You can step back in time, technically back to 87 when the tax law changed. Typically, you won't go back that far, but technically you can go back to 87 without amending your tax return. So
Um,
no amended, you can grab it all in the current year, picking up bonus if that was in play during the year. So I'll zip through this for us quickly and then hopefully be off of this presentation thing.
okay,
But
good.
it does
This is
to
helpful.
show. So, okay, so client here since 16 has taken 285,000 under straight line. Again, this the snapshot before cost seg. We reallocate 21%. And as you see, 144K goes into 5-year life, 108K into 15-year. So what that means is they're going to jump from 285, which is where they are today. They're going to say, hey, wait a minute, IRS. Listen, we've taken 285K. Oh, we should have taken 423K. We're grabbing 135K of depreciation in this tax year. And so that means we're going to defer 54K in tax right off the bat. So that's a 2016 acquisition. Now, I so it, this is a real life one of a client we had. They bought a building in 2023 for 18 mil, and these numbers are just staggering. So it goes from 354K they would have gotten without a cost seg. With cost seg, they get 3.5 mil. They basically picked up 3.2 mil of depreciation. First year tax deferral, 1.2 mil. So that's what's out there. I'll stop this for now. And then if you want to come back to what other questions, I don't want to get bogged down in a PowerPoint.
Well, no, that was actually really helpful. So thanks, Jeff. Look, so lots of questions, but before we jump into the chat with some of these questions, um, I would say first and foremost, don't be overwhelmed by this because I remember when someone first showed me this, I just saw the bubbles that you showed me basically, and I was like, I'm in. It seems a little bit complicated, and it's really not too complicated, nor is it something that you have to be great at. This is what Jeff does in his firm. So you have the right firm that does this cost seg for you, which then you bring to your accountant or CPA, right? And they then will apply it where it makes sense. And so that's the valuable thing that you and I don't have to do. When I say you, listeners and I, Jeff and his firm does. And so that being said, that's if you've got any real estate, it sounds like in the last couple decades, and looking for some additional bonus depreciation, real estate professional or not, right? Because if you aren't, then you can deduct it against passive. It can go forward, and if you are a real estate professional, it has massive benefits for you today. And actually, I started the call off wrong, maybe wrong. I don't know. You tell me, Jeff. But I said this doesn't really apply to a lot of you because we're gonna have to do it for more for next year. But it sounds like if you've had some assets for a little while, you might be able to sneak it in. I don't know that Jeff can in the next 2 weeks, but maybe you can. I don't know, Jeff. You tell me.
So
Is
here's the deal.
it in
So, and
April?
there's,
Yeah. When do you have to do it?
well, it's a great question. And there's lots of my competitors out there who are not necessarily always giving the full story. And I'll leave it at that. But the deal is, regardless of what they tell you, you can do this up until the extended due date of your return. So don't listen to
October?
somebody.
October of next year?
Yeah, you can do this for 24.
This is great. I
I
didn't know.
know.
I thought it was till April. I thought it was till April.
Well, so that's so there's 315 for corps. Personal is 415, April 15th. So
Yep.
March and April 15th, corporate
Yep.
versus personal. And then there's the extension of 6 months, which pushes it to 915 corp, 1015 for personal. So depending on whether you're corporate or personal, you've got until 915 or 1015 of next year to apply this for 24. The reason a lot of people do want to get them done at or near the year end here is because they can make their changes in their estimated tax payments that they're going to have to make in January. So let's say the payment won't be due until 3/15 or 4/15, but often there's a preliminary payment that would be due in January. And so if you know what the numbers are looking like sooner versus later, you can start to whittle down what you have to peel out, because you'll still have to make estimated payments. But if you know the cost seg is coming in, you can reduce what you have to pay.
Perfect. All right. So I'm going to do a quick timeout here before we go to the chat and the questions because there's tons of them. I noticed. So this is great, Jeff. And what I wanted to share real quick is Alex is in here. He's in the chat. We're going to start tackling some of these questions and answering them. So, but I am going to say if Alex has got our link to schedule an appointment, also our link if you just want to get more information. Also, Jeff's got his information right there, and you can see it on the screen.
Yeah.
His numbers right there. This in his website. So feel free to reach out to him. Also, you can feel free to email us and say, "Hey, I'd love to just get his Jeff's contact information." Obviously, we're going to give it to you in the chat. Alex has got that. But schedule if you've got one thing. I was going as you're talking about this, and I know people have asked me, is what are some, what's another way? How does this apply about which assets do I put inside my IRA or outside my IRA? This is a perfect example of of picking and choosing the right asset classes to have your IRA own. So I love typically lending uh, my IRA. I don't, if there's an asset where I'm going to get a huge bonus depreciation, I'm not going to have my IRA own it. Why? Because your IRA doesn't get the write-offs and doesn't pass through to you personally. And so I just want to make that really clear. Those, the savvy investors that understand this and or learning like me still, you need to pick and choose which assets you think that you can do this on, and which assets that are a little more passive that you're not going to get cost sag. It might be a different scenario where you're investing in a fund or you're lending, etc. That could be great for those kind of asset classes for your IRA. And then for those that want to convert into a Roth, obviously this is great for those real estate professionals too. So I'll pause on that, or at least wanted to just share. And then Alex is putting there a link, and we'll also share Jeff's information with you here in the chat. So if we don't answer something, you can reach out to Jeff. I assume that's okay with you, Jeff, right? You're
That's
always quick about
yeah.
responding to anybody. So can we jump in? Do you want to jump into some of this chat? And I usually have Alex kind of help us with some of this chat. Is that all right, Alex? You want to throw some questions at Jeff and I so we're not bogged down on all of it? Is Alex there? If not, I can start jumping in. I think you're
Oh,
there.
sorry. Looks like I muted myself in one part, but not in the other. You guys can hear me now?
Yep, perfect.
We got you.
Perfect. All right. Well, it looks like the questions have been rolling in, so great questions from the crowd. And thanks, Jeff. That was very informative. Anna was asking, does a cost segregation need to be done this year for a property that was purchased this year? That was one of the first questions that came in.
I saw that question pop up and I was like, so it does not. You can do it. Our firm, with our bandwidth, we can get it done quickly before your tax filing deadlines. So you have until the extended due date or whenever you file. It needs to be done before you file. Theoretically, that could be 9/15 or 10/15. So it does not have to be done. And don't let anyone tell you out there that's email blasting or the snake oil people telling you, oh, you better hurry up and do it this year because bonus drops next year. Yes, it does drop, but bonus applies only to the year you acquired the property, not the year you're doing the study. So don't fall for that malarkey.
That's good.
Perfect. Anna then kind of had a follow-up question a little bit down where it said, do you know if the itemized deduction is then required or that can be taken using the standard deduction? I understand that you're not a tax professional, just curious if you happen to know.
I'm not sure that, I mean, I've been doing this a long time and nobody's asked me that directly. So I don't, think you have to give up one or the other, but you're going to be in a more complicated situation. This is going to apply. Means your asset is going to fall onto a depreciation schedule, but I don't think that means you negate the standard deduction. But I'm not 100% sure on that. That would be a question for your CPA.
Perfect. So for that one, Anna, we've dropped the information into the chat, or I'll be doing that here shortly. Be sure to kind of schedule a call, and like Jeff said, talk with your CPA. That it's going to be your best method right there. Next question that we kind of had here was might not be cost seg related exactly, but it was still in here, and I was like, and I want to touch on it. So Greg, this might be for you. Janet's asking, I've heard that we can transfer our accounts from being trads to a Roth. Is that possible?
Yeah, for sure. For those of you listening that have a self-directed traditional account or simple or SEP, you can convert it into a Roth. And it's really talking a bit to your accountant to make sure you do it at the right time. And you can also do it in segments. Like you could have, $100,000 in a traditional, but if you convert too much, it could kick you actually into an upper tax bracket. So you don't want to do that. So let's say that you could convert 50,000 of it, only half of it, so that way you don't get moved up into a higher tax bracket. That might be the right move. So yeah, you can definitely convert it.
And the next one, also not cost seg related, but it's still a great question. Frank is asking, is there a way to buy crypto and sell crypto through a Roth IRA? And then second part was, can you have a self-directed account and a non-self-directed account?
Yeah, for sure. You can have both, and you can buy crypto. That is the big story these days, right? Ever since the politics have changed for a second, crypto's I've had an uptick in crypto. Before the voting, it was an uptick in precious metals. Everyone was buying gold. But yes, you can buy both with your self-directed IRA, and you can have two different types. You can have a self-directed and a non-self-directed account. You can have a traditional account with your broker or anywhere else. So yeah.
Perfect. Back to some of our cost seg questions. Was Wayne asking, can cost seg be applied to rental properties owned within self-directed IRAs?
Typically, as Greg mentioned, that's going to be, you've got a tax benefit already by doing the self-directed. And typically, under a lot of circumstances, it probably wouldn't make sense necessarily to do that because you've already given yourself a tax wrapper, a tax benefit being the self-directed, and you would theoretically be spending money and not really being able to do much with that benefit. Now, there could be situations where you've jacked up the basis out, possibly outside of the self-directed, and maybe that would work, but that would be more of a Greg question, I think.
No, you nailed it. That's correct. So it doesn't cost seg, and the bonus depreciation doesn't really go hand in hand with self-directing, with the exception of what we talked about prior, where it can help you make a decision on when to convert, and or when to take out money out of your retirement account. If you have a traditional account and you start taking distributions, you're gonna have to pay tax on those distributions. So if you are a real estate professional, there's some definite benefits of that, so of avoiding taxes. So yeah.
On that note, I want to commend you, Greg, because you're giving up your airtime to talk to something that doesn't necessarily coincide exactly like hand in glove with you're having me here, and we don't necessarily work together per se, but you're giving your audience here information that is beneficial to them because they're in the space.
Yeah.
So
Well,
congrats
well,
to you for
well,
looking
well,
out for your
well, I mean,
listeners.
look, thank you. I appreciate it, Jeff. And just on a side note, our trust company does 75% of our investors are investing in some kind of real estate. And so this is definitely is a great subject for them. So thanks for sharing that. I got more questions here. How about that one? If you cost seg on an Airbnb, do you still have to meet the 750 hours to be a real estate professional, or is it less on a cost seg for an Airbnb?
There, so Airbnb, okay, so imagine two buildings, two residential properties, side by side. and they're built by the same builder at the same time. Everything's identical about them. One is long-term rental, i.e., like an apartment or just rented a year at a time with a lease. That's 27 and a half year. The same exact building next door is rented out short-term rental. So they do weekly rentals, let's say. Well, that's not treated like long-term rental now. That's going to be treated like a hotel. Hotel is an active trader business. It's going to have a 39-year life. And so the owner manager of that short-term rental Airbnb property does not have to hit the 750-hour test. If they're managing it and they're doing most of the work, not saying they have to do everything, not saying they have to be there the ones that are cutting the lawns, not saying they have to be the ones shoveling the snow or the whatever, but they have to be doing a lot of the management. If they're doing that, they can use that as an active trader business, and that would go against their W-2 income. So no, you don't have to hit that 750 hours if you're short-term Airbnb kind of people.
Hmm, that's interesting. Okay.
It's a nice little carve out.
Yeah,
It was
didn't know that. That's great. I mean, all kinds of good nuggets here. All right, so next question here. Sorry, Alex, I got excited and I started looking at the
You're
chats.
good. You're good.
So if you want to go to something else, I was just going to ask, how long does it typically take you to do a cost seg? I know obviously on your $18 million project, probably a little different than your $400,000 project, but maybe not. You tell me, what's the average time to get that done?
Our normal turnaround time is 6 to 8 weeks.
Okay.
So that's from stem to stern. So from when the client says, hey, let's go, till we get everything done, because typically what our team does is collect the data up front. We then do the site visit. The IRS requires that. Watch out for the snake oil people that say, oh, we do virtual site visits. I've seen so many cost segs get blown up by the IRS because they're not doing real site visits. And they're saying, oh, we're cheaper. Oh, don't worry about that. We'll just have you do a FaceTime with us. IRS blows those up 100% of the time. So you got to watch out for that. Anyway, 6 to 8 weeks, whether it's a little property or a big one, we have the capacity. If somebody says, I need this for whatever reason, ASAP, we can get it done in 2 weeks. If somebody says, oh, we're going to extend anyway, so we've got until 9:15 or 10:15, then we can go slower. So it's whatever the client wants.
Okay.
Um,
All right. Peter asked here, what's the situation where cost seg doesn't make sense?
Great. That's a great question. I saw that pop up and I was like, oh, I want to deal with that. So if you're a buy and flip person, probably not going to work for you. Not going to make sense because you're buying a property quickly. Or I should say, you're buying a property, fixing it up, and then selling it off quickly. The IRS considers that an active trader business in and of itself, and you're not. They're going to treat it like inventory, the property. So if you're like a developer or a buy and flipper and you're not holding them long, you're not going to get to depreciate the building. You're not going to take advantage of cost seg. So short, short-term holds. If you're in a loss already, so if you're creating enough losses and you're not paying income tax, as crazy as that sounds, some people are in that situation where they're just not getting enough taxable income from the properties. It doesn't make sense to pay money to do a cost seg on it when you're not paying tax anyway. It's
Well,
it's
well, sorry, I interrupted you. What is long term and short term? When you say what do you recommend? What's long term and short term?
So we would say it makes sense or it's viable if you're going to buy, build, or improve a property and hold it for 3 to 5 years at a minimum. Meaning, so you're going to hold it for 3 years, you're probably going to make sense to get that 4 or 5 to 1. The reason I say that is, oh, unless you're going to do 1031. And if you're going to do a 1031, then even a shorter term hold is fine if you're 1031ing up the food chain.
Mhm.
Um, the reason I say that is because if you do, if you don't do cost seg, you're going to have recapture. That's where the IRS grabs back depreciation you claimed, and you're going to have to almost say you've got to give some of that tax benefit back. So if you don't do cost seg, you've got recapture. If you do cost seg, you've got recapture. Either way, you've got recapture. The distinction is with a cost seg in hand, you're going to have a higher recapture bite. So if
Mhm.
you're only going to hold the property for say 2 years or closer to the 3 year mark, it probably doesn't make sense to do unless you're
Mhm.
doing 1031. But once you get to the 3 to 5 year hold, now you're going to retain that dough longer and be able to do something better with it. So as opposed to sending it to Washington, D.C., if you think, hey, I can use this tax savings today to go buy another property or to improve my second unit in my three family, bam, now you're using what would have been government tax payments. You're using that money to improve your property, charge a higher rent, get yourself into that next property more quickly. So you can parlay that into a bigger portfolio more quickly.
And that's what it's about, right? Time is money, and you build your wealth as quick as possible. And this allows you to do that. This is one of the vehicles that allows you to this. I mean, I don't know. I mean, some people just get bored when it talks about tax savings. This is sexy stuff to me. This is right down my alley. So thank you for being here again. So Diana had a question. Changing the subject. Transferred from you transferred your SEP IRA into a solo K. Was that a good move? Look, I always say, you could ask your advisor, but I'd say also from my experience, a lot of people do that because they're looking to contribute more to the retirement account. When you have a solo K, you most likely can contribute more into it than you can into your SEP, number one. Number two, it could make sense because you also can borrow. When you have 401k, you can borrow up to $50,000 if you needed to for something. So there's a few extra benefits associated to a solo K over a SEP IRA. But both types of accounts are good. But no, Diana, I mean, I don't know your whole situation, but I don't think that was probably, I don't see that as a bad move. Um, let's see here. You might have to help me on this one. Besides, hi Al, can you kindly comment on moving stocks from W-2 long-term incentive pre-tax and moving these into Horizon and a Roth? I don't think I can answer that one, at least not right now, unless you've got a comment. This is my category probably, unless Jeff, you got
It's
something.
not my category, man.
All right.
Stocks are not
I,
my thing. So
I got to go back to you on that we'll have to get back to you. And Alex, have you put in here? I assume you have the link for people to schedule an appointment and or ask questions. And again, my email, Greg Herlean at Horizon Trust Company. I respond to all the emails. If you just want to email me, there it is, Alex. If you just want to email me and say, hey, get me with Jeff, although he's got you there as well, your information, please definitely reach out to us. Um, Let's see. Diana, I was told I could use to invest into any asset, including real estate. You can use your self-directed IRA to invest in almost any asset. There's a few exceptions when using your retirement account. You can't, there's prohibited transactions. You can't lend to your kids or your parents or your spouse. You can't invest in insurance policies or collectibles or things like that, but or a home that you live in. I'm just kind of perusing here. I don't know if you have as well, Jeff. There's something that we've missed here as far as questions go. I feel like we've done pretty good. Our contact information's there. Is there anything else? Last questions coming in before we wrap up? Yes, Peter, LOL. Sexy tax stuff for sure. Majority of work to meet the material. Um, let's see here. I think that's about it. Jeff, is there, as we wrap up, we try to keep it within an hour or less. So is there anything you want to kind of wrap up as far as comments go, or any questions you saw in there that you want to answer to as we wrap up?
well, I see there's two different categories. You've got the chat thing going on, and you've got Q&A. So on the Q&A one, there's a
Do it.
question about $5 million. Somebody invests 100 grand. Does bonus depreciation apply to the investment portion of the property purchase price? So it's not the investment portion. It's what your 100 grand investment bought you as a percentage of the overall $5 million purchase. So if that somehow bought you 10%, not that it necessarily would, but let's say it did, you put in 100 grand of the $5 million purchase, and that was 10% of, you got 10% of ownership, then you would get 10% of the depreciation on that $5 million asset. And one quick wrinkle to that is if one of the investors in that group said, you know what, I don't need to, oh, I've got self-directed, I don't need the deductions, he could waive off on taking those in theory and let somebody else take them. So that can be done as an operating agreement addendum that says, Fred says he's not going to take them, but Mary Lou wants to take them. And so she's going to take his deductions that he would have got. So
Perfect.
we,
Uh,
we can do a quick, like 6 or 8 question, little, questionnaire of like street address, because we do a quick Google Earth. We, need to know purchase price, date of purchase, what the building is. Is it a retail property? We can give you that um, estimate side-by-side comparison for your own property, let you know what it looks like. And basically, anytime you're above that 300K, 350, 400K, somewhere in there, whether it's multiple properties, probably it's not going to work if you've got a bunch of $50,000 properties. But if you had some properties and we can mash them together, cost seg is probably going to make sense, depending on your situation.
all right, let's try to nail some of these real quick. What is the approximate cost for cost seg? Is there a range on that?
It um it can typically be somewhere between, on the low end, maybe like $3,000 to get everything, free audit support and all of everything that I've described here. We do the 3115s to step back in time, and it would, in theory, go up from there. We're not going to be the cheap guys that do the virtual site visits with FaceTime and all of that. So we provide free audit support. We provide the 3115s when those are needed. And also the details so that the client can take write-offs in the future when they replace roofs and HVAC. Many of my competitors out there don't do that. And so those are some of the things that differentiate us from other folks.
Yeah, and look, and there's so much cost savings or tax savings that it's a no-brainer. You want the right people doing this because you don't want to get audited. And if you do get audited, you want to have someone stand behind you to make sure it's done right. So it's you don't want to go cheap on this and use the right or the wrong firm. So another question here, real quick, from Mike. What characteristics would a house have to get the most upfront cost seg? Landscapes, trees. What has the shortest useful life? Trying to figure out what kind of properties to buy for residential rentals. Does that make sense?
So anytime you buy a property, so it might be, I'm going to say on a residential property, it could be a 15% reallocation to a 25%, let's say. If you put super, super, super deluxe stuff in there, it might go up to 30%. The distinction between the 15 and, let's say, the 25 is urban versus suburban. Okay. Meaning, if you buy a property and it's in a downtown urban setting, whether you're thinking New York City or Albuquerque downtown, there's not going to be big parking spaces. There's not going to be a yard. There's not going to be a lot of trees. There's going to be a sidewalk right around the building if you're in downtown. Versus being in a suburban setting, you're going to have a yard. You're going to have a driveway. You're going to have irrigation system. You're going to have fences and drainage ditches and stuff outside the property. So the big distinction is how much dirt is around the property, because you get to take what they call land improvements. So once the property is bigger than the footprint of the structure, you get a better bang for your buck.
Perfect. All right. Last question here from Anna regarding active and material participation. I read that you can do bonus depreciation even if you are on a W-2, but put in 100 hours of active participation and meet the material participation requirement. Does that make sense?
I'm not sure where she's getting 100 hours.
Bonus depreciation if you are W-2, but put in 100 hours of active participation and meet the material participation requirement.
I don't know where the 100 hours is coming from unless she's talking short-term rental. And yes, you would get bonus. And again, short-term rental, you can get that. If she wants to give me a call, we can talk about that. I have a brain surgeon who makes 4 to 5 mil a year doing brain surgery in a big Boston hospital. He also owns, because he makes good amount of dough, he goes and buys lots of properties. And he got all wound up and he was like, Jeff, I think I should be a real estate professional, blah, blah, blah. And he's saying that he wants to use this against his W-2. And I'm like, hey, I don't care what you do. It's your accountant that has to sign your tax return, not me. His accountant was on the line. And so his accountant said, so, Henry, so you're going to tell me you're going to sit with the IRS when they're auditing you, and you're going to say you make 4 to 5 million a year doing brain surgery, yet the 500,000 a year you make in real estate is your primary job. You're going to tell that to the IRS guy and expect him to buy it. And Henry, the brain surgeon, literally, was like, well, when you put it that way, I guess I'm not going to do that. And I said, that's probably logical, but I'm not sure where the 100 hours is coming from.
All right, well, good. Well, look, we'll wrap up today. I really appreciate your time, Jeff. And you've got our contact information. Reach out to us, hit the link, re-listen the video, and obviously reach out to Jeff if you need any help on your cost seg and getting a cost seg report on your properties. Thanks again for being here, Jeff, and this evening. Thanks a lot.
Thank you for having me. It was great to be here with you, and look forward to working with you guys in the future as well.
Hey, thanks for watching this video. Hopefully you enjoyed it. There's lots more great content for you to learn and enjoy and apply to. And so anyways, click on the link below and listen to more videos or set an appointment with us. We look forward to hearing from you and also helping you.